Well, welcome, everybody. Greetings to you. I have today Clive Thompson, Mr. Clive Thompson, on my channel for the first time, who's a very experienced fellow, and it would be good to hear his take on things. And I've listened to his work before. Not always agree on everything, but we think probably pretty much in agreement on most of the fundamentals. So I'm going to just chuck it around a little bit, and I want to bring a few things in, not necessarily in an order of importance, because one thing tends to lead to another, and hopefully we can have an interesting discussion for, I don't know, half an hour, see how it runs. Half an hour I always find is about a good time. So, well, Clive, if I may address you as such, perhaps you'd like to just give us a background on where you come from, where you've been, what have you been doing?
Well, hello, Godfrey, and thank you very much for inviting me on your channel. I hope I won't let your listeners down. I'm retired now. I've been retired a couple of years, and before that, I spent 47 years in wealth management, specifically looking after high net worth individuals and their structures and things like that. Most of my career has been here in Switzerland, where I'm sitting at the moment. I'm quite close to Geneva, and you're in the UK, I think, Godfrey. Am I right?
That's right. Yes, indeed.
Yeah, so we're just 1 hour ahead of you. It's just after lunchtime. Yeah, my career's been in wealth management, and I'm quite in my retirement. I'm following up, keeping abreast of the financial affairs of the world, perhaps even more so than when I was working. And that's about it.
That's super. Now, have you been in Switzerland for a long time? Has that been the main platform for your advice? Yeah.
So after working for about 10 years, I came to Switzerland, and so it's about 37, 40 years in Switzerland now.
Right. Oh, good. So because then you won't mind if I bowl a few questions about Switzerland at you. You'll know your way around perfectly well. As I say, they're not in necessarily any order, but one thing leads to another, and I've written them down, which I don't often do, but I didn't want to miss anything. First off, from a perhaps largely constitutional point of view, Switzerland seems to be, and you correct me if I'm wrong, it's only a feeling I'm getting this side of Europe, in the UK, that Switzerland seems to be edging a little bit away from its very strict neutrality in geopolitical matters that we have been used to, perhaps until the last 15 years or so, perhaps. Now, have I misinterpreted that, or what's your thinking? And one thing I do tend to notice with my Swiss guests and Swiss friends is that, quite interestingly, it seems to me that the Swiss people haven't changed at all in their view of neutrality. But as always, governments seem to not like neutrality. They always seem to want to come down on the side of one group or another. And that also leads into confidentiality of assets, so on and so forth. Have I misread that, or would you say that I'm right, or part right, or what?
Well, Switzerland is and has always wanted to be a very neutral country. But I think it's been somewhat backed into a corner by the rest of the world, or rather the Western powers of the world, that includes Europe and the USA, to be a little bit more aligned with the international view. And therefore, Switzerland has imposed sanctions, or reiterated the sanctions imposed by America on Russia, for example. And in terms of confidentiality, that's all gone now since many, many years when it comes to tax secrecy. So there's no question whatsoever of anybody parking assets in Switzerland from a secrecy point of view as far as taxes are concerned. But on the other hand, Swiss confidentiality is enshrined in the law for all other aspects. So I can't go around talking about who my clients are or what they're doing with specific names. So we have large elements of what used to be the Swiss secrecy, which I'll call rather confidentiality, and we have large elements of the neutrality, but it's not as strong as it was, say, 30 years ago.
Yeah, I think I pretty get that. Force majeure, one might say. Well, an observation on that, I think that's a sad thing, because I think that if ever a country with a background of Switzerland, and Switzerland's neutrality has no more, is it would it be more welcome than a neutral country globally to actually perhaps broker agreements and peace agreements and confidential agreements between governments as well as private clients. So I think that's a great shame. And I can't see anybody else. I can't see another country with the stature of Switzerland who could really pick that out. So I think the West, I have to say the West, really, let's be frank, North Americas, the European Union, have actually shot themselves in the foot because they have missed out on opportunity to utilize Swiss neutrality to everyone's advantage. So I think that's a shame.
Well, let's just say I think it's probably still the best of the bunch, if not as good as it used to be, and that explains why we have literally hundreds of international organizations clustered around Geneva, and many of the major world conferences regarding peace and so on are held somewhere in Switzerland. So it still retains quite a large degree of its status as a neutral country for these sort of things.
So let's just talk a little bit, if we may, about banks. I wrote a book, a small book, more of an aid memoir than a book, about 12 years ago, called The Magic of Banking. And it was suggesting that we were coming to a banking and fiat currency crisis in the fullness of time. Second edition came out, sold quite well, actually, as an aid memoir. You can read it in an hour. It's for the educated layman, as it were, your surgeon, your barrister, whatever it happens to be, who wants things explained without too much jargon, and so how he can protect him and his family. Now, if we look at banks today, and I got wrong a little bit, one sentence in my book. I thought the first banks to really be suffering would be European banks, not American banks. And it seems to me I was slightly wrong on that, but I think that's probably just a question of timing. It seems that this is happening in a very, very slowly. And the problem with banks, I can't see that going away. And I can't see the financial deposit guarantees that are given in Western Europe, the UK and North America, being of any significant value if what I think is going to happen to banks happens to banks. Am I paranoid, or have I got a point? Or
I think it's dangerous to exclude anything, and certainly a collapse of the commercial banking sector is a possibility. It's not my central scenario. I think they're going to muddle through, and I think they're going to bail out the banks when necessary to ensure that does not happen, just as happened in 2008 when we literally had a global collapse of the banking system, and many banks which exist today wouldn't be in existence were it not for a bailout by the government. So I do think that whilst it is a possibility, it's not the scenario that I'm expecting to happen or looking for to happen. But on the other hand, a lot of banks have assets on their books at a value which is more than their worth, and those sort of assets are specifically the loans, the commercial loans they made to companies, and more specifically commercial real estate loans, where a great deal of commercial real estate is worth less than it was when those loans were granted 5 or 10 years ago. So we know what's changed. We've had the COVID epidemic, and people have learned to work from home, and now companies no longer need as many floors in their central town office buildings as they used to need. And that does mean that in many cases, when those leases come to maturity, the tenant will be saying to the landlord, I don't need 5 floors anymore, I only need 3 or 2, which means the landlord will have empty floors, and there'll be, as everybody else will be just saying the same thing, there's going to be a lot of vacant space, or the tenants will be saying, because there's a lot of space, I want a rent reduction. Now, when you get rent reductions because the landlord isn't renting out all his space, the consequence of that is that the landlord has less money with which to pay the financing on any loans. And here lies a secondary problem, that as these loans get rolled over, because many of these loans were for 3 or 5 or 10 years, as the loans get rolled over, they were at the very low fixed interest rate of 5 or 10 years ago, which in the United States, was about 0.25%. In Europe was negative. I'm not talking about the loan itself, but I'm talking about the rate above which you have a margin. And in the UK, it was about 1%. So all of those rates today are much higher than they were. So when these loans do mature, they'll be rolled over, if they can be, for another 3, 5, or 10 years at much higher rates. So the landlords are going to be, those who do roll it over, are going to be facing a problem of paying more interest on their bank loan and receiving less in rental income. What that means is many of them won't be viable anymore. And in some cases, they'll be returning the keys back to the bank. In other cases, they'll be simply selling their properties, and in many cases, not receiving anything like what the bank lent on. So typically the bank will have lent on 60, maybe 70% of the value of the property, and those properties may not be worth that. So what does that mean from a bank loan perspective, from the bank's asset point of view? If the property today is worth less than 100% of what it was worth when they lent the money, whilst they might say they're still covered because it's only worth 80%, that margin of safety has gone. And in many cases, it's completely gone. It's in negative territory, which means that they don't know what's happening, because provided the landlord keeps paying the interest, and he might be at the moment, if at some point the landlord cannot or will not, then the value of those assets of the banks are in trouble. So I think the size of the problem is bigger than I'm talking about the USA here, but I think it's extended to the rest of the world. But the USA, I have a better view of the figures. I think the size of the problem is bigger than the size of the Deposit Insurance Guarantee Fund, but that can always be increased to some extent. So I don't think I'm saying it's a complete disaster, but I do think it's dangerous if you have too much money in the bank, especially if your balance is large, and you might face some sort of haircut in a national disaster or a crisis. And I myself have personal experience of suffering in a particular crisis where the ECB deprived private investors like myself of their money in several ways. Obviously, Cyprus was one of them, but the other way was on the Greek government debt, where the ECB helped itself to 100%, failing to respect the pari passu laws, where everybody should be treated equally. That's an example. So if you do have large balances, you may find that you're not treated as equally as those who have small balances, and you may find you're not treated as equally as the Federal Reserve or the ECB or the Bank of England or whoever is the party which needs to be repaid to save the system.
I was in New York last week, actually, and believe it or not, I hadn't been to New York for at least 3 or 4 or 5 years, and still that forest of tall buildings still overwhelms one as one sails in. I sailed this time into New York, and of course that's replicated right across North America, and replicated, of course, to a significant extent in Western Europe, or not quite so much. So it seems to me, as you quite rightly say, there's got to be a fairly massive haircut on those loans. And would you not agree? Of course, long bonds, long dollar bonds have taken a similar haircut. If you bank to market, if you put that in the asset sheet as well, there's another bottom line that doesn't quite mix. So would it seem to me that if the banks are going to be rescued, and the numbers are much bigger than 2007, 2008, you can only do this by quantitative easing in some form, no matter how well hidden, on a fairly big, massive scale, thereby degrading the dollar further? Or am I missing a trick?
I think that's what's coming down the line. And perhaps I should say it's not just the banks who hold long-dated bonds, which are worth less than the value they paid for them. It's also the Federal Reserve in the United States, and this will be replicated by other central banks around the world. So, as an illustration, the Federal Reserve, I I haven't got the figures in my head, but they hold something like 7 trillion of US government bonds, which were bought over the last decade at interest rates about 2.5%, 2%. And right now, because the interest rate on 10-year bonds, for example, is 4.5%, those bonds are worth significantly less than what they paid for them. The decline in value has wiped out the Federal Reserve's capital reserves many, many times over. And it's not just that which is eroding the Federal Reserve's capital reserves. It's also the fact that the Federal Reserve is paying investors at the short end, at the 3-month end, 5.5%, 5.4% in interest, but are only earning 2.4 on average from their book of Treasury bonds, which means they're literally losing billions a week. And those losses are being, which ought to be booked to the profit and loss account, are being booked not to the profit and loss account, but booked as if they were an asset. Now, accountants will understand how you can do that. Obviously, that would be illegal if it was a corporation, but the Federal Reserve has got its own rule book about how you can do your accounting, and it's allowed to book losses as assets. Strange as it may sound, that's according to the rule book, which has been written by the Federal Reserve Board of Governors themselves. So when I don't want to say the Federal Reserve is in trouble as such, because literally they've got trillions of dollars, several $1 trillion of cash, which they printed and which is out there. And that cash is never going to come back and say, please pay me, because all they're going to pay them is another bit of cash, another dollar for a dollar. So in a way, one might say the cash is a sort of reserve, even though it's technically a liability of the Federal Reserve. But realistically speaking, if the Federal Reserve was a corporation, it would be, or a bank, it would be very, very deeply insolvent and no doubt have to go into administration. But that's not going to happen under their accounting rules.
If we switch to the United Kingdom for a moment, where not all, but a number of my subscribers are resident, we have a sort of a similar situation here, it would seem, again with accountancy procedure, and I'm not an accountant. We do have this same problem, it seems to me, in how we actually show our debt, our national debt in this country. So the Chancellor of the Exchequer stands up every year at the dispatch box, and we've had many of them. And we're coming up to an election on the 4th of July, not without some irony. What the problem I think we have here is we're not showing the figures as they really are. And again, this will be at least the 10th election that I've gone through, because I'm an old geezer now. I'm 75, so I've seen quite a lot of stuff go through. Not showing the books and not talking about what needs to happen. And we know that if we are, as individuals and or businesses, we know that you cannot continually spend more money than you actually bring in income in whatever format that may be. And we haven't had a balanced account as a country in the United Kingdom since I think it was 1988, 89 or something like that. And then it was only more by accident than design. And we show our debt as a percentage of GDP, which of course both of us, I'm quite sure, would agree is a very fake and ridiculous way of measuring from an economic perspective. But that seems to be the accepted way. So we have this problem where we say, oh, it's 110 or it's 115% of GDP, our debt. But if you add those things which are never ever discussed in mainstream media, like index-linked public sector pensions, for which the liability is not far short of £1 trillion sterling, quite an extraordinary figure, and growing every day. And there's been an increase of several 100,000 civil servants just in the last few years in the UK. So this index-linked pension system has been ballooning all the time. Now, if you take that into consideration, you would find, and I don't like GDP, but we'll use it here for the sake of argument, that our debt is in the region of something like 210% of GDP, which is roundabout where Greece is. But nobody talks about it, and we're going into an election where, yet again, the two main parties are out trying to outbid each other on what they will spend, not what they will cut. And I would argue, and I'm very much interested in your view on this, rising interest rates are talked about all the time, rising interest rates to counter inflation, both in North America and the United Kingdom, to an extent, to a lesser extent, Western Europe. But the long and short of it is rising interest rates. And if you look at Volcker and you look at that took 8 or 9 years to actually, like stopping a tanker in midstream. You can't deal with inflation unless you drastically slash government spending. You have to have the two things in unison. Now, nobody talks about this over here. Do you have a view, or am I wrong?
You're absolutely right. I mean, there were a lot of things in there. I mean, I think the main thrust here is that every government has got undisclosed liabilities in the form of Medicare, pensions, social security obligations, and so forth. But if I could just step back for the benefit of your listeners to the early 1980s, at the time that Europe was coming together to form the European Union. At that particular time, and it still is the case, it was widely thought by economists that for a developed country, the debt to GDP ratio, the gross domestic product, should not exceed 60%. In other words, debt should not exceed 60% of the gross domestic product in any country, beyond which it would become a situation where it would become unmanageable and bad for the economy. So when the European Union was formed, all the countries who wanted to join the EU and ultimately the euro had to sign up to the Maastricht Agreement, which agreed that nobody would ever allow their debt to GDP ratio exceed 60%. The figure was thought to be 40% for a developing nation, but for the developed, 60% was the level. Now, there were one or two countries which had higher debt levels than 60%. I think Greece and Italy were two of them as examples, but they at least promised to get their debt to GDP ratio back down below the 60%. Great Britain at the time was around 40%, and most of Europe was, most major countries in Europe were around 40% debt to GDP. Where we are today, Britain is the official number, and I know we've got the unofficial number, which is much higher, but the official number is around 100% in the United Kingdom. In most of Europe, it's around 100%, and that's as an average. Of course, there are countries with much, much higher levels, and the United States has exceeded 100% of debt to GDP. So what this means, in all countries, the debt is growing much faster than the national income. So the debt now represents a much higher percentage of national income. It also measures is a much higher percentage of the Treasury's tax take. That's the income that's being earned by the government. And the interest on that national debt continues to rise and rise, so much so that we will reach a point where the interest ultimately, and it won't be very many years, exceeds the taxes that are being collected. Now, from one point of view, we could say if the interest that they're paying on the national debt is as much as or exceeding the tax collected, there's no money to spend on anything else. But of course there will be, because they'll just keep borrowing and more and so on, and keep going ad infinitum. At least that's their plan, to allow that debt to grow larger and larger at an ever faster rate. But we know that that can't continue ad infinitum, because at some point a little boy shouts, "Hey, the emperor's got no clothes," and everybody runs for their lives. And it's not like it happens slowly. When it happens, it can happen very, very fast. And then there's a currency crisis, or a crisis in the bond market, or some other political crisis, and suddenly for the currency, it's game over, and they have to restart the system with something new, some new kind of system.
Which, of course, brings us to central bank digital currencies. There's got to be an off ramp, as the Americans would call it. There's got to be an off ramp, and one would assume that this, as everybody's talking the same language. Certainly in the West, they're all talking the same language, and it's all the 2030 is the deadline, and the UN. So we're all going to have this new system, and of course, I don't trust banks. I don't trust politicians. Don't trust anybody really. When it comes to money, because they will swindle you if they possibly can. And of course, it's programmable. And we will find ourselves, if we're not careful in the system, everything is tracked by your bank, by your central bank, and they have all the power, and eventually they will tell you what you can spend that money. Just like, and I just vaguely remember ration books. I was born in 1949. There were still one or two ration books kicked around. You had your ration. That's enough meat. And of course, it comes under the cloak of saving the planet, which of course is nonsense, but it has to be for our own benefit. Otherwise, to try and get this sort of stuff through, they have to pretend it's all for our own benefit. And if we don't do it, we're all going to die. And of course, when you've got when you've pretty well lost your free press on some of these subjects, there's nobody coming on the screen to tell you that these things are either dangerous or nonsense. So this is one of the problems I think that we have, which brings me neatly to gold. And as JP Morgan says, and we've been very familiar with this, of course, I think it was in 1912, only gold is money. I'm a gold bug. I make no excuses for it. In fact, I think somebody might produce stuff. I've got the biggest gold page now in not-for-profit gold page in Britain. And it's contributions from all over the world from people on this matter, gold bugs, and indeed Bitcoin bugs, which is a rabbit hole I don't intend to go down, because I don't really want to go down there, because it's a genuine rabbit hole, and I don't think there's another upside to it. But I heard your views on your the last interview I heard. You were, I mean right in saying you were empathetic to gold, and you thought, yes, okay, there's a role for gold, but you don't see perhaps gold as being quite as important maybe as I do. What's your view? And I'm not talking about necessarily going back to a gold-backed currency, which I don't see as being practical. But generally speaking, if you include BRICS and they're looking for a currency, they're trying to find a currency. But it seems to me, if you've got the Indians wanting to trade with China and Russia, so you've got the ruble, the rupee, the yuan, and so on and so forth, do you need to bother with all that kind of thing if you can exchange in gold? Tell me your views.
Well, we're at 5 minutes to midnight in terms of the time for a new monetary system. Over the last 100 years, we've had effectively three monetary systems in a sort of sense. We were on the gold standard up until the 1930s, and to a certain extent to the 1970s. From Bretton Woods in 1944 onwards, we had the dollar system. So that was that. And then after 1971, we were in a free float world. So those were effectively the three types of monetary system we had. And the one we're in at the moment, the free float, is at 5 minutes to midnight. It can't last much longer because of the levels of government debt. The one feature of the free float system has been one which has removed the constraints on central banks from increasing the money supply, and removed the constraint from governments of borrowing ad infinitum to finance every crisis, every problem, and of course refinance their re-elections by spending more money, something you alluded to for the next election, who's going to spend the most money. So that system is drawing to a close. I can't tell you how long it will continue to last, but I don't think it'll be another decade. I think it'll be in the next decade. Well, it'll come to an, and then it'll be time for a new system. And when we have a new system, it could take many forms, but one of the reasons that central banks around the world are accumulating gold is gold might play a major role. Might not be a gold-backed currency, but it might play a major role in the new monetary system, where those who have the gold are calling the shots. So we have large governments around the world, China in particular, who are Russia also actually, who are accumulating gold hand over fist. They're a long, long way from having the amount of gold that the United States has got, but they're going in that direction, and I think that's going to continue. So from that perspective, I would align myself with the central banks and say if they think it's a good idea, I think it's a good idea to have some too. But I think there's a more important thing going on in the world for gold, and that is, well, there's two other things. Let's start off with the first one. The second one is also China, but in this case, it's not the government of China, it's the man in the street. The man in the street in China has traditionally been saving by buying houses and apartments. That's gone out of the window because suddenly we're faced with a situation in China where there are millions of half-finished houses and apartments because they can't sell anymore, and the property companies are going bankrupt left, right, and centre. There is some sort of bailout by the government, but it's not very much in total, so it won't really. I don't think it'll solve the problem, but it is leaving people very, very scathed with respect to property. So those who are in the middle class, who were saving traditionally by buying another apartment and renting it out, aren't going to be doing that anymore. Property is a bad deal. Stock markets are volatile. They don't really. The man in the street is not investing in the stock market the way British do or the Americans do. It's not a very popular thing there. So where are they turning to? And I think they're turning to the jewelry shops. And so they get heading into the jewelry shops in China and buying gold items. Now, for those who are unfamiliar with the way gold is sold in Asia, it's a little bit different from what you experience in the UK. In the UK, you go into a jewelry shop and you'll see a ring and there's a price, and you can find out how much gold it is by asking the right questions. But really, it's not very transparent for the average buyer. In Asia, everything is extremely transparent when it comes to buying gold. Each item of jewelry has the precise weight in pure grams of gold on it, and on the wall there will be a gold price, to be possibly a gold price buy and sell as well, but certainly a gold price. Next to the item, next to the weight, is also another item which is called the labor cost. So when you go into a gold shop, you can take the weight in grams multiplied by the price on the wall and add the labor charge. So you know exactly how much gold you're getting for your money, and you can also know quickly and easily what you're going to get if you sell it back. You won't recuperate the labor cost, and if there's any tax, you won't recuperate that. But you'll get the price of the wall, or the price of the wall minus whatever discount they have for that. So a lot of people like to save in gold jewelry, and that would be often chunky type jewelry like bars or chunky chains, that sort of thing. And I think that's what's going on. My evidence that is happening is I looked at the latest reports of some jewelry companies, some large jewelry chains in China, and they're all reporting huge increases in their gold jewelry sales, of the order of 60%. Year on year for the latest quarter that I could find, or the latest half year I could find. So, in my opinion, the man in the street is buying gold because he's not willing to buy stocks, and he certainly isn't going to go near the property market anymore. And that, I think, is the new form of saving in China. So I think the Chinese are sucking out the gold from the West, and that explains why gold is trading at a small premium. I think I've seen it up to $90 per ounce in Shanghai. It's typically around $30 or $40, but it's trading at a premium over there because the gold is flowing from from west to east, and people are buying it at a higher price in China.
Interesting, is it not, that if this continues and the Chinaman on the Shanghai omnibus, as it were, is doing this, and I read it exactly the same way. That's exactly how I read it. And there are millions and millions of them turning away from property and stocks to precious metals, let's just call it, or gold, if you will, maybe silver. In these numbers, and there's so many of them, and they save the latest figures I could find for the Chinese middle class was they are tending to save round about 30% of their income. This is miles, of course, ahead of Western society, which doesn't actually save at all. The Western societies don't save. They live paycheck to paycheck, sometimes because they have to and sometimes because, they want to. So this isn't an extraordinary phenomenon, and it wasn't ever thus. So the other thing which is interesting, just from a gold perspective, as we're just talking about gold, and that is that, broadly speaking, the investment portfolio in the West really doesn't hold very much gold. I think when I'm right, and you probably pick me up on this if I'm wrong, because I'm trying to sort of go back from memory, that you would expect a portfolio of 30 or 40 years ago to have 4% exposure to gold. It's now maybe 0.5% exposure. We just don't buy gold. The English middle class don't buy gold. Nobody buys gold coins or bars. It's beginning to come to people's attention, but it's not where you might think it should be, given the circumstances in the West, in America. But of course, if the middle classes in North America, Western Europe, and the UK started to go down the line of the Chinese, and with those sort of percentages of savings, and decided to go that route prior to our property crash, which is coming, in my view, as an old geezer, I've seen it all before. So it's an interesting phenomenon, but I think perhaps with your background in wealth management and mine in pension fund investment, which are twin sides of the same coin, basically, perhaps there has to be a sea change in how people in the West now appreciate saving and for their family and what they do.
When I first arrived in Switzerland around 40 odd years ago, it was quite common to have around 10% of gold in an investment portfolio. That the gold itself as part of the investment portfolio never went away, but over the decades, the amount which was typically in a portfolio dwindled, not because gold was going down relative to other things, but because investment managers, the powers that be, felt that we should own more other things, and gold was becoming less significant as an asset in portfolio management. So that kind of dwindled away towards before I retired, a year or two before I retired, maybe as little as 1% exposure to gold in Swiss banking portfolios. It was starting to rise by the time I retired. I was typically trying to push my portfolios to have as much as 3, going on 5%, but that would have been breaking the bank's rules had I gone as high as 5%. So I didn't want to really do that without the client's permission. But I recently, about a year ago, published on LinkedIn what I saw was the ideal asset allocation at that time. And I did put in 6% exposure to gold and 6% exposure to silver. So that would have been 12% exposure to precious metals, which I thought was the right number about a year ago, along with all the other things you should have in a portfolio. So my view is shifting upwards in terms of the exposure one should have to gold and silver, and I see that happening a little bit here and there. I'm talking to old banking colleagues, and I think the view is shifting in favor of having more gold than they used to. But I am talking Switzerland, where there's always been a traditional liking for gold. I'm not sure how much that is happening in the UK or America or other places in Europe. Probably it's happening in Germany, but maybe a lot of Europe, and Austria probably, but a lot of Europe probably is not very interested in it yet, but it will come.
Yeah, interesting. It's all very interesting. Of course, we would perhaps, as we are old-fashioned in the sense of the word, that we would regard gold as a store of wealth, as opposed to being an investment. I think it should be part of an investment portfolio, but with a slightly different risk analysis perspective on it, and a time frame, and a different time frame.
I see it as a form of insurance or a parachute. I'm not expecting it. It might well be the best performing asset class in the short term, in the coming years, but long term, I don't think it's going to be the best performing asset class. But I think you've got to have it for the insurance aspect, and because other asset classes could, given the environment we're in, where inflation is starting to creep upwards, I think it's the right thing to have in the portfolio, more than you would have had a year ago or 2 years ago.
Certainly, it's historically a good hedge on commodity increases. Oil in particular, of course, oil. If you look at the correlation between gold and oil, I think I took it back once to about 1910, and it's almost quite remarkable. It's quite spooky, and of course copper as well now. But anyway, leaving that aside, crystal ball type stuff. So that's really helpful. Thank you very much for bouncing all that off me. And sometimes when I'm up here in the UK, it's nice to bounce it off from a personal perspective, because sometimes I think I'm going barking mad when I read what politicians are doing at the moment. I'm going mad. Am I losing it? So, well, thank you again.
You're in the very fortunate position. You've been around the block a few times, so you know which way the wind blows and which way it's likely to blow. But a lot of the portfolio managers haven't even got half the years on you, and there's a lot of stuff they haven't seen, and they're going to get a lot of surprises, which won't surprise you at all.
I know. I was in the city. My nephew is an underwriter at Lloyd's in his early 30s, very successful young man. And about once a quarter, I go drink lots of beer in Leadenhall Market because I'm still fit enough to stay with them for a bit, him and his mates. And I always have a wry smile. You know, they ain't really seen anything yet because they've been brought up through university now in their early 30s. Having not really experienced anything nasty in life. And I think there's some nasty coming down the road, although I don't wish it upon them, incidentally. But anyway, thank you again, Clive, and I hope perhaps I can persuade you to come on again for another chat, perhaps when things move on a bit in the autumn and things have moved on and we can see where we are.
With great pleasure. I think a great topic for the next one would be what will actually happen when the end to the present financial system comes, and how will it be replaced, and how could you protect yourself financially?
We'll do on that. We'll do that in early autumn or before if things start showing up. Thank you so much again. As most of you know, my work is very heavily independently research based. And I get my information from all over the world. It would help if you press the subscribe button and the little bell next to it, because the more subscribers I have, the more likely it is that international independent research institutes will share their material with me. It's most helpful, and then of course I automatically share it with you. So surprise won't cost you anything. Thank you very much.